Listen to me. If you are retired, or if you are anywhere near retiring, you need to wake up and pay attention right now. I talk to thousands of people just like you who are terrified of outliving their money, worried sick that a medical crisis or nursing home stay is going to wipe out everything they worked their entire lives to build. So what do? You buy a long-term care insurance policy. You pay thousands of dollars a year in premiums because you want protection, you want peace of mind, and you want to leave something for your kids. But then tax season rolls around, and you sit there asking yourself, can I deduct these massive long-term care insurance premiums on my taxes? Can I get some relief from Uncle Sam? Here is the honest truth, and I am not going to sugarcoat it for you. Yes, you can deduct them, but only if you play by the IRS's strict rules. Too many of you assume that just because you paid $4,000 or $5,000 in premiums this year, you automatically get to slice that right off your taxable income. Wrong. If you make that mistake without understanding how the tax code works, you are setting yourself up for a devastating disappointment or, worse, an audit. Let's break down exactly how this works so you don't lose a single dollar you're entitled to. First, your policy must be a tax-qualified long-term care insurance contract. Most traditional policies purchased in recent years qualify, but if you have a newer hybrid life insurance or annuity policy with a long-term care rider, only the specific portion of the premium allocated to long-term care counts. Call your insurance carrier today and ask them, is my policy tax qualified under Section 7702B, and what exact dollar amount is eligible? Do not guess. Second, the IRS puts an age-based cap on how much premium you can even count toward your deduction each year per person. They do not let you write off unlimited amounts. For example, if you are between the ages of 61 and 70, the IRS allows you to count up to $4,810 per person as an eligible medical expense. If you are age 71 or older, that cap goes up to over $6,000 per person. If you and your spouse are both in your 70s and both have qualified policies, you each get your own limit. Now, here is the huge catch that trips everybody up. For most individual filers, long-term care premiums are classified as medical expenses. That means two major hurdles stand in your way on Schedule A. Hurdle number 1, you must itemize your deductions. Ever since the standard deduction was raised, the vast majority of retirees take the standard deduction. If your total itemized deductions don't beat your standard deduction, including your LTC insurance premium won't reduce your federal tax bill by 1 penny. Hurdle number 2, even if you itemize, you can only deduct total medical expenses that exceed 7.5% of your adjusted gross income, AGI. If your AGI is $70,000, 7.5% of that is $5,250. You only get to deduct medical expenses, including your capped LTC premium, that go above $5,250. So what are your actionable takeaways right now? How do you actually win this tax game? Number 1, if you are self-employed, even if you do consulting, freelancing, or run a small business in retirement, you might be able to take the self-employed health insurance deduction right on page 1 of Form 1040. That means you don't have to itemize and you don't have to clear that 7.5% threshold to get the deduction up to your age-based limit. That is a massive tax win. Number 2, do you have a health savings account, HSA? You can pay your qualified long-term care insurance premiums directly out of your HSA completely tax-free, up to those same IRS age-based limits. That is 100% tax-free money working for you. Do not sit back and leave your financial future to chance. Review your policy, talk to a qualified CPA or tax professional before filing, and make sure you are squeezing every single legitimate tax benefit out of the coverage you pay so hard for. Stand up, take control of your money, and secure your retirement today.